everyone. Welcome to our summer webinar, Expanding Your Reach this Summer with Servion's Retail Channel. Today with us, we have Dan Olson, our Retail Manager, and Rachel Mangelcook, our Product and Development Training Manager. And of course, my name is Ariel Jacobson. I am your Retail Account Manager. We're so excited to have everyone joining us this summer for this opportunity to learn how to grow your footprint with the Servion Mortgage Retail Channel. So we want to remind everyone of a few housekeeping items. Up in the top right corner, you're going to see a question mark and a little bubble that will allow you to ask questions during the webinar. If you do have any questions throughout, please feel free to type those in the chat function and we'll get them answered as quickly as possible. All right, let's get started. What we'd like to remind you is that you can always be listening for opportunities. Now, this can start in many different ways when we discuss mortgages. First and foremost, there are a lot of ways that the conversation can start. I hear a lot as an account manager that the conversation starts from a member service representative having a simple conversation. This could be that the member mentions they just got married. That means potentially that they have two incomes that have entered the household, or maybe they've welcomed a new child into the family and they simply need some more space to grow. There are other opportunities such as paying off or paying equity to an ex-spouse, or potentially children leaving the home and members needing to downsize or sell a home. There are also ways to seek opportunities if the member is looking for home improvements with a cash out refinance, or in recent news, a lot of need to consolidate debt. These are all different lifestyle changes, all different ways that you can ask for an application or the start of an application. We're going to go into a few other tips and listening for opportunities and how that really comes about when we start to think about mortgage applications in our next slide. I always like to remind partners is this is not a sales pitch. You are not pitching Servion to your member or your borrower yet. What you're doing is simply asking them questions and guiding them through the first part of the process. You're building the relationship so that they come back, see you as a resource, and ask more questions. A lot of member service representatives and loan officers are alike are really kind of nervous at the onslaught of starting that conversation because they don't know what the member or borrower might say next. What I like to think about is asking a friend. Something that comes up a lot in conversation is, are you moving? What are rates doing? Things of that nature. Just keep the conversation going. Keep the same tone that you would in discussing something with a friend or a colleague, and just start to move that conversation along. Ask them for their email address, their phone number, and make sure that you're staying in touch. That's one of the best ways that you can become conversational and help understand the member's needs and how that progression is going to occur. There are a lot of common questions that come up in mortgages. The wonderful thing about the retail channel is you do not need to be the expert. You just need to know what to say next. This comes up a lot when we talk about rates. What I say, because I am not a licensed loan officer, is, hey, that's a great question. Mortgage rates change so frequently, sometimes even several times a day, and the loan officer is going to help determine the type of loan and the personal financial picture of your member or borrower. Right now, it's again about gathering information and just knowing what to say next to keep that conversation going. The other question that comes up quite frequently is, am I pulling credit or are you? How long is that credit good for? How long is my pre-qualification good for? There's going to be a lot of questions up front. Rest assured, Servion and our team are going to be the ones pulling credit in the retail channel and monitoring that process. You'll have a credit report that's good for 120 days. And beyond that point, what we see is members that continue to shop for homes but are still pre-approved go back to the loan officer, speak to that originator here at Servion, and sometimes update documentation and have the credit report repulled. We understand that can be a part of the process, and that is completely something we are prepared to work with and know what to say next. Next, we're going to go over some additional details when it comes to putting on your mortgage hat. When you put on your mortgage hat, what you're doing is you're thinking like a loan officer. And we are going to offer you one of these hats if you take our electronic training. This offers a speedy pre-approval process for your customer, and we have found that you can close up to 60% more additional loans when you gather documentation up front. All you need to request at the point of application is a W-2, 30 days of recent pay stubs, credit union or bank statements, especially when we consider the source of a down payment, and to document the source of that down payment. And another tip and trick I like to give partners is to take a copy or pull a copy of a driver's license. This is going to ensure you have a full and complete application and that you can complete the process once you refer the loan to Servion. As always, our team is here to help with those documentation requests and to ensure that they are coming through and reaching the portal. So me, along with our team here at Servion, are also additional resources when it comes to what to ask for upfront. But if you wear your mortgage hat, you'll remember it is those top 4 items. Now we're going to go over to Dan, and he is going to talk a little bit about portfolio lending in our retail channel.
Thanks a lot there, Ariel. I appreciate it. What I want to talk about here today is a lot of times our retail partners don't know that they have the ability to offer portfolio loans, whether they are saleable or non-saleable loans, or how it really works. And what that is basically it's that we're going to fund the loan, but we're going to have you guys, wire us the funds. We'll fund it, we'll service it, we'll do everything for you guys. You guys are just the investor, right? If it's a saleable loan, we are following Fannie and Freddie Mac's guidelines. You cannot do a portfolio loan on government loan, FHA, VA, USDA, VA loans. You can only do them on the conventional loans. If they're outside the normal guidelines, you have the ability to do those on non-saleable portfolio loans. Now, a lot of times the lender, the partners don't really understand what it really costs. What I always tell everybody is that the cost for a portfolio loan is 1% origination fee along with an $8.95 processing fee. Now, it's either the borrower pays it or the partner pays it, right? So someone's got to pay it. So you as the partner have the ability to portfolio it. And most of the time, we're always going to charge the borrower that portfolio fee, unless you guys tell us up front. We do have credit union partners that do, hey, we'll do this we'll portfolio it. We're only going to charge the borrower 0.5 point. We'll cover the other 0.5 point, right? So that is what the cost is. The benefit there is in the back end is once you guys do it too is we basically keep 25 basis points of the interest, and then you guys get the rest on the monthly basis. That's for our servicing of the loan. So that is the portfolio stuff. Let me talk a little bit about our next slide here, which is going to be for the PMI. Now, actually, take it back. That is going to be for the ARMs. PMI is one slide ahead. So for the ARMs, also another thing that you guys do that you guys don't really know or have the ability to do is create your own ARM portfolio products, right? A lot of times, if you want to do it as a non-saleable loan, we are currently working with a lot of retail partners right now that are currently creating adjustable rate products, right? A 5 or 7-year adjustable rate mortgage product. We also have some partners that do ARMs as a 5-5 ARM or a 3-3 ARM. Some of these partners do land loans with these ARM products that are a 3-3 over a 15-year term, or a 5-5 over a 30-year term, right? His portfolio loans, that is something that you guys just get in touch with me on or your account executive, and what we can do is set up a certain criteria of how you guys want it with the index, the margin, how you guys want to price these adjustable rate mortgages, right? We can set it up to really customize it to really any way that you guys want to do it. We have the ability to do that for you. But a lot of times, partners don't understand that they have the ability to create these ARM products. Now, on to the next slide that I jumped ahead with already, is going to be talking a little bit about the PMI. Now, one of the things about the PMI is that when you're doing a saleable loan, portfolio loan, is that if it's less than 80%, or say more than 80% loan to value, you're going to have PMI on there. Saleable loan, that just meets the Fannie and Freddie guidelines, right? So you're going to end up having that PMI on there. There's nothing special about that other than just the normal process. But a lot of times in doing a non-saleable portfolio loan is that you don't know that you have the ability to do a non-saleable portfolio loan and get PMI. So you have the ability to offer PMI on a non-saleable portfolio loan. Now, it does technically have to meet some certain, basically I always say the normal underwriting guidelines. But as long as it does, like if you're creating a 5-year ARM or something and you're doing 95% loan to value, you are able to get PMI if it just, it meets all this normal standard stuff. The only thing that's making it a non-saleable is going to be the 5-year ARM, right? So that is one thing to keep in mind while you expand your product portfolios, right? Is that, hey, when creating an ARM product, you can get PMI on that. If that is something that you want, make sure you let us know when you approve a ARM product or really any non-saleable one. Now, the other side of that too is that let's say the property doesn't meet the normal guidelines, or there are some situations why we're doing this as a non-saleable portfolio loan due to them not having a 2-year employment history or not having a social security number, an I-10. So it's stuff like that we can't get PMI on, but most of the time, as long as it meets the normal criteria, we're going to be able to get the PMI for you guys there. So that's one thing you guys don't know. So with that being said, if you guys do have any questions on portfolios, if you guys have any questions on creating an ARM product or PMI, here's all my contact information directly. Go ahead and get in touch with me there, and I can answer any of you guys' questions there. Or if you guys do have any quick questions here, I can answer those before I hand everything off over to Rachel, and she will take it from here as far as some product stuff for you guys.
All right, just looking to see if there were any questions. I don't see any that came in. So thank you, Dan. Moving into product, a lot of times for retail, like just to piggyback on the PMI bit a smidge, Arch has some very specialized programs that they can do PMI on that are not secondary market loans, offering, higher LTVs to doctors. They have a professional program. MGIC has some similar things. So if you're looking to target a particular audience, or you're in a market that has certain clientele, working with your MI rep to be able to offer some additional products is great. We can help facilitate that as well. So just a reminder on that. So this is going to be a fairly brief overview on products. Really want to make sure that people remember what we offer as a part of the secondary market. So Servion does conventional loans. Hopefully you all know what a conventional loan is. We are both a Fannie and Freddie seller servicer of conventional loans, so operating in our 45 states across the country. Those are going to be available for properties that are 1 to 4 units, residential in nature. They can be primary residence, second homes, or investment properties. We can do LTVs as high as 97% LTV, so that would be a minimal 3% down payment. Those can also have second mortgages attached with them for down payment assistance if there's a community development program in the area that's offering either a lien or a grant. Those can typically be used with a conventional loan to CLTVs as high as 105%. With conventional loans, a lot of it is very credit score based. It's where Servion is looking at an automated approval, so it's going to be whether or not a desktop underwriter or loan product advisor likes the loan and it fits into the risk analysis for either Fannie or Freddie. Couple things to remember is that there is not a maximum acreage limitation on a conventional loan. If you have those loans that are 100 acres, as long as the highest and best use of the property is residential, that's something that we can move forward with, provided the appraiser can provide similar comparable sales to show that that is common for the area and acceptable in the market. There are a couple other down payment things that are available with a conventional loan. There are Home Ready and Home Possible loan programs. These are targeting lower income borrowers at reduced mortgage insurance rates, as well as limiting the loan level price adjustments that can happen on the loan. So the interest rate is typically better. As well as that, there's also down payment funds that are available. So both Fannie and Freddie are offering a $2,500 down payment assistance grant, really for very low income purchase owners in rural areas. So those are available if the borrower is at or below 50% of the area median income. So in those low income earners, there may be funds available as well through Fannie or Freddie. Servion also does FHA loans. So FHA loans are part of our product mix. We are a Ginnie seller and securitizer. So we do have a few overlays on an FHA loan where we are looking for that 620 credit score. FHA in general, since it's a government-backed loan, it is used for the purpose of refinancing or purchasing a primary residence, so not for second homes or investment properties. It can be used on up to 4 units, and you can do those 4 units at 96.5 LTV, which is that 3.5% down. Our team, so we see that a lot of a fair amount of our retail partners are ones that are great at doing conventional loans and they want us to take care of the FHA loan, which is a great option. Our team knows what they're doing. We have processors that support, and we do a pretty good job at making sure the customer, borrower, member fits into the loan program right away, so that we can make sure the loan offer that we are moving forward with is something that they actually qualify for, and we can bring that loan to closing. The other thing that's in particular about FHA loans is that they are assumable. So a conventional loan, if you sell the property, the mortgage has to be paid off. On an FHA loan and on other government loans, the loan, if the seller is selling the property, the buyer may have the ability to assume that existing mortgage, and that's come into play more since we've seen the rate market that we're in right now, where some of those sellers have that really low interest rate from the early 2020s where they're at 3 or 4%, and now the new buyer is looking at something that maybe starts with a 7. If they have the ability to qualify for that loan and have some additional down payment money to come up with, they can do an assumption. So Dan is also our master of assumptions, so he speaks with all of our borrowers for assumptions as well. So if that scenario comes into play, the borrower would work with the seller's servicer. So I see we did have a question here. Is the assistance for low income the VLIP? So yeah, Lori, the VLIP, so very low income purchase credit, it is $2,500. It comes back to you or back to us from Fannie or Freddie. Once we sell them the loan, we regain that $2,500. It ends up looking like a $2,500 lender credit on the CD and a $2,500 grant from Fannie or Freddie on the IRLA. Okay. USDA loans, some of you that I saw on this call have dabbled in USDA loans. USDA loans is like having the toolbox be full. Can you offer it? So they are particular to certain areas of the country or areas in the state that are deemed more rural. So typically in MSAs under under $10,000. 10,000 people. This is what happens when I look at the questions while I'm talking. As well as being rural in nature. So with a USDA loan, they are for one unit properties, 100% financing, so no down payment, still allows for a good chunk of seller contributions at 6%. Again, for primary residents, that 620 credit score. The part about USDA loans is they get run through their own underwriting system, GUS, guaranteed underwriting system. It's a little finicky, so it doesn't necessarily like everybody, even though they have a 620 and it meets all the criteria. So that makes offering USDA a little more difficult at times, but overall for Servion, USDA is a very small percentage. I think we're still looking at around 2% of the volume that we do is USDA loans. But again, it's giving you a product offering so that you can compete in your market and offer as much as you can to your membership or client base. Next up, VA loans. So Servion does offer the VA home loan benefit out there to veterans that allows for 100% financing. Our minimum credit score, again, Servion has an overlay in that respect of 600. The VA does offer, I think the most misunderstood part of a VA home loan is that they can use their benefit more than once. So a lot of the veterans believe they can only use it one time, so maybe they save it up and don't utilize it until they're going to buy their forever home, when they can use it over and over again as long as they have entitlement available. Learning about VA loans, there's some confusing parts to it when I do training on VA home loans and talking about entitlement and how that works. It's very confusing and counterintuitive for what you would think. So again, if it's not your forte, utilizing our retail team to do your VA loans is a great idea as well. Other benefits of VA loans, the LTVs again at 100%. Debt ratios allow for whatever we can get approved through the automated system, whether it be DU or LP. LP is a little finicky on VA loans, so I recommend running DU. And then does allow for 4% seller pays, but it has a limitation on costs that can be charged to the veteran. So it does usually makes the VA loan more affordable for the veteran. So here I see we have a question. When will Servion get VA and FHA construction loans? So thanks, Vern, for that question. At this point in time, we don't have any construction loan programs at Servion. We can do the end loan, and particularly on VA, typically the end loan is a cash out refinance now, where we're paying off that interim construction loan and gathering some additional builder documentation. I don't know. At this point, I don't see a timeline for Servion adding VA and FHA construction loans into our mix. Certainly, when we, if or when we come about with that, you guys will get communications from us about it. Okay, while I showed you the last couple slides are really some program flyers. We could utilize those in your branches. Those are things that could be co-branded, that could have your logos on them, as well as, just having some basic information. So if you have any interest in utilizing any of those slides or getting those co-branded, certainly reach out to Ariel. She can make that happen for you, and make those available. And then really the thing that I try to point everybody to is our product matrix, but I didn't want to go over our product matrix line by line. So product matrix covers Servion's product offering. We talked about conventional. There will be one that has Freddie on it as well. Currently, this is primarily Fannie Mae guidelines, FHA, VA, USDA. I didn't specifically talk about jumbo programs. I do have jumbo programs available, both up to 2 million on second homes and primary residences, as well as a new program that we launched in the end of February that does loan amounts up to 3 million, that covers both, or sorry, all three of the occupancies, primary, second home, and investment property. So if you're working with that high buck borrower, we do have more jumbo options available than we've had in the past, and those are available on both an ARM program or on a 30-year fixed. And that non-conforming arm that we have on there, that I see being utilized most often in a second home capacity. The loan level price adjustments on that program for a second home are significantly less than they are on Fannie or Freddie. I believe the adjustment is 1 1/8 for a second home versus, depending on your credit score and LTV, I think the second home adjustment on a conventional loan can be as high as like 4 1/4. So that's going to make an impact on your rate. Okay. So if we just check in for any other product questions, again, high level review, utilizing the product matrix. This thing is currently, I believe, 7 pages long. It covers the basics of what's available, what LTVs can you do for primary, single family residence, and as well as second homes, investment properties. The other pages include DROG credit requirements, seasoning requirements, property inspection requirements. And then let's see, non-conforming ARM terms. So for the non-conforming ARM, those are the same as that jumbo to the right of it. We can do the 5/1, 7/1, or 10/1 ARM, as well as the 30-year fixed. And then I have another comment. Oh, thank you, Dan. As a reminder, when we're talking about programs and assumptions, government loans are assumable. So FHA, VA, and USDA loans are all assumable. I don't know that we've done a USDA assumption yet, but we've certainly dabbled in, oh, looks like we've done one. Okay, we've certainly done FHA and VA ones. So those are available. Unfortunately, conventional loans are not assumable in that you can't sell your property to somebody else. You can certainly do a transfer of liability if someone passes away. That can be done. So if there's questions about that, again, if they're loans that are being serviced by Servion, Dan's going to be your point of contact for those.
Yeah, just reach out to me.
Perfect. All right. So, couple of things. Why do I want to use retail? Right. A lot of you on the call are partnered with us in other channels. There's some reasons to use retail, even if you are a correspondent or wholesale or delegated partner. Um, the basic reason, you don't have loan officers in your office. So we're here to help. A lot of our retail partners have the branch manager or a member service rep doing an application, and that's where Servion can fit in and our retail channel can assist. So the other places, your loan officers are on vacation. Maybe you only have one. They're taking a vacation or they're out on leave, paternity leave, maternity leave, some sort of medical leave where they're not available in the office. We can certainly be that fill-in loan officer while they're away. The training that we have for retail, and this is really for anybody who's new to mortgage. REL has put together, I think, 6 different sessions of very quick online trainings. They're interactive. They are intended to help the user understand what a mortgage is, give them some basic lingo for mortgages so that they have a better understanding, go through our online application system so they understand how to upload an application, what documents should be gathered in that process, and really just give that, my lovable term for them is that green bean employee, some more knowledge so that they can have that conversation a little more comfortably and understand some of those basics of mortgage lending. On retail, you get paid 100 basis points for every loan that we close. So when the financial institution enters in the application through Servion's Consumer Connect site that is co-branded with you, and do your required 6 pieces on the HLE task sheet, then your 100 basis points are paid out after the loans are closed. Some of you are only looking to make 100 basis points. Does it make sense for your mortgage operation to have staff to originate and process? Maybe referring loans to Servion is the answer to reduce the cost in your operation. Some of the other things I talked about are doing loans that are outside of your comfort level. Maybe you're great at conventional loans. Your loan officers have been doing them. They're good at doing FHA loans. They have kept up with it. They do them. They're familiar with the little intricacies of doing an FHA loan. But USDA, you want to be able to offer it, but it's just not worth the time to train your staff and go through that. So that's where we can step in and assist. Same with any of the programs. The last bullet point on here is if the loan's outside of your lending footprint. So if you aren't a wholesale partner, you don't want to go down that path. Your membership base is, limited to Minnesota and Wisconsin, and you have a lot of snowbirds that are doing loans in Florida, want to purchase properties there or, south, we can be the answer for that as well. Okay, so again, Servion, our retail channel, has a lot of ways to help you. You can create your own programs. You can certainly offer the secondary market programs that we offer. We have training to help you. And we have, a great path of communication to keep in contact and keep your person at the credit union informed as to what's happening on the loan as it moves through the process. All right. So I'll just look here and see if there's any other chats or questions. I don't see any. All right, I'll turn this back over to Ariel to wrap us up.
Thank you so much, Rachel. It's wonderful to see so many partners in attendance today. We really want to reiterate the fact that we are your partner in all of this. We're here when you need to know more, but you don't have those immediate answers. I would encourage you to submit some last questions here, as Rachel has some availability on this webinar to answer them, and she's at the ready. There are really maybe 2 types of callers here. If you're an existing retail partner, you might need some more training. to feel wholly ready to begin offering those USDA, FHA, VA products. If that is the case, you're going to want to reach out to myself or Rachel, and we will get you signed up and ready to go. Additionally, you're going to get a certificate for that training, and you're going to be able to display that certificate and at least have a base level of knowledge under your belt, and you can even show that off to make sure that everyone knows you got credentialed with Servion. And you get, for a limited time only, the hat. If you're interested in wholesaler delegated options, that's going to be an account executive territory. So if you are located in the following states or interested in lending in those states, you're going to want to reach out to one of our account executive team members. We're certainly happy to route those calls, or you can call the main number and be routed appropriately if those were options that you need assistance with. The account executives are more than happy to start having that conversation and deciding exactly what direction you need to go in order to really maximize those programs. And again, we want to be an extension of your team. That's always our goal here at Servion, is to make the process seamless for your member borrowers and to make sure that everything goes according to plan and smooth. And we know there are a lot of hands in the mix when it comes to mortgage, but we pride ourselves on being a wonderful liaison in that process. So we always want to ensure that you have the opportunity to reach out. We really thank everyone for taking what was likely an extended lunch break with us this afternoon, attending the call. We are going to stay online for another couple of minutes in case questions roll in to answer those. And again, thank you for joining us, and we hope you are able to expand your footprint with the retail channel for the remainder of summer and beyond.
So we did have a couple of comments and questions. PowerPoint will be available. Recording will be sent out here shortly. That will have the link to the recording as well as the PowerPoint for it too. And thank you, Angie. We're happy to show our faces to you.
And your Yeti might be in the mail because she's a star participant.
All right. As always, thank you everyone for your partnership and for participating in our webinar today.
Have a good one, everybody.